So as we continue our discussion about intermarket analysis, one of the most popular markets to pair is commodities with the commodity currencies. And we talked about that a little bit with just a little teaser there with oil and the Kiwi. Now, that's an interesting one because traders will oftentimes say, well, that's kind of unusual. I mean, New Zealand's not exactly the biggest exporter of oil. Why is it that a decline in oil prices would contribute to a decline or indicate the likelihood of a decline in the value of the Kiwi? The premise is, of course, that commodities in general or on the whole are fairly correlated. They're driven by many of the same macroeconomic issues and factors. So when you see commodity prices rising, what that means is that there is going to be demand for more of the currencies that are required to buy those commodities. So those would include the pound, the Canadian dollar, the New Zealand dollar, the Australian dollar, and some of the exotics like the Norwegian krona, etc. So what you'll find is that there's not a lot of difference in the movement between, let's say, gold prices, which is a chart that I have up right now, and oil prices. Now, there are a few subtleties here, but and sometimes you will see some intraday differences, so some differences from day to day even that you can take advantage of, and it's in fact enough of a difference. So on the whole, very similar, but enough of a difference on the day to day or in the short term that it makes it worthwhile to build two watch lists. I tend to look for gold and oil in one list, and then I'll have the commodity currencies lined up in another. When I see a breakout in gold or a breakout in oil or some such, one direction or the other, I'll look across my portfolio of commodity currencies. Do I have one that's standing out and is really not conforming to that particular movement? Here's a specific example. Right now I have a gold chart up. I'm going to zoom in just a little bit on this. And the most recent candle is up. So we saw a little appreciation in gold prices up to about 970. So this is useful information because at the same time I've got an Australian dollar, one of those commodity currencies, and one of those currencies is going to be required to buy gold. So Australia is, in fact, unlike the New Zealand oil relationship, Australia is a big producer and exporter of gold prices, as is some of the more exotic currencies like the South African rand. So looking at the Australian dollar here, we've got contrary movement. Now it's not a huge difference. Sometimes you'll see these breakouts be really big. The one with oil and the New Zealand dollar was a golden opportunity because the difference was really wide. And of course, the bigger the difference, the more likely it is that the trade is going to go your direction. However, this is still an interesting opportunity. And what would we be looking for? Well, we'd be looking for an opportunity to go long the currency in this intermarket relationship. So the Australian dollar, what we're assuming is that it's likely to pop up. So why is it that I would be considering a long position on the Australian dollar versus a short position on gold? They've diverged from each other. The markets are probably going to snap back. You can see how very similar they are over similar periods of time. So which one? Why would I make the decision that I'm going to go long the Australian dollar? It's not just a matter of me being a currency trader, and therefore I automatically want to opt for the Australian dollar because I trade gold futures as well. It's as many other traders out there do. The reason why we do that is it's in favor of the prevailing trend. So now we're looking at this is a very short-term opportunity, just like the one that we looked at on the New Zealand dollar. So what's the short-term trend? Well, the short-term trend is to the upside. So we've got a short-term trend going here over the last few months on gold, and in fact over the last several months to the upside. Same thing here with the Australian dollar. We have this short-term trend that's heading to the upside. So we're erring on the side of basically it's a momentum play. Gold is telling us that there's an opportunity in favor of the prevailing trend, which was exactly the opposite situation that we had in the Kiwi, which had been downtrending for the last few months. So we had a short-term trend on the Kiwi that was to the downside. We had a short-term rally on the Kiwi that was contrary to a decline in oil prices. Well, that's great because the prevailing trend in the Kiwi then makes it susceptible to a correction to the downside. Just as in this situation here, the prevailing trend on the Australian dollar, which is to the upside over the last couple of months, makes it, it gives it a short-term propensity to break out to the upside again. So that's why we would make that decision as to which side of the market are we going to trade and what direction. So we've been looking at a past example, but here's a couple of really classic recent examples. So this was happening on the 26th of June here, where we got this big breakout in gold. This was, as you can see, relative to the previous candles, this was a big breakout. Well, at the same time on the Aussie, we had, in fact, a little bit of a down day. But what was the prevailing trend? Well, the recent trend over the last couple of weeks had been to the upside, and on the Australian dollar, it had been to the upside for a number of months, as a matter of fact. So what side do we err on? Well, we start to look for long positions on that currency, which worked out, of course, in the very short term, the next day, and over the next week and a half or so, but has worked out really well over the last couple of weeks as the breakout on gold continued as well. Well, virtually the identical situation as the market was cooling off just a couple of days later. On July 1st, we've got another nice big candle on gold. While at the same time, on the 1st of July, we've got a little bit of downside movement on the Australian dollar. Well, what's the prevailing trend? And of course, the next day we correct in favor of the prevailing trend as the commodity itself, or as the commodity currency itself, catches up with the commodity market. So gold in this case. As you can see, this is what we've discussed so far as a fairly short-term strategy, and the reason why I approached it this way was just to be able to make the point. It is very dramatic in the short term, but the same principles really apply in the longer term as well, which is something we're going to be looking at here as we start to dig a little bit deeper into these intermarket relationships. So we're not quite done with commodities yet. We're going to dig in a little bit deeper in the next section, and then we'll start to look in some of the other financial capital markets and how they relate to other capital markets and specifically to currencies within the Forex.